Hello and welcome to the first episode of Investors Hangout in 2025. Wish you all a very happy new year. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, as we step into 2025, let's vow to make smarter investment decisions. And to help us do that, we have with us Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Now, to begin with the current market scenario, what key factors do you think investors should prioritize when selecting mutual funds in 2025?
One is that mutual funds, investors in 2025 or even earlier, but I would say at the cost of repeating, that don't try to make your investing process interesting, exciting. Let it be boring. Keep doing the simple things. Ask questions before you do it. And keeping investing simple and understandable is crucial. And we are getting into a very different territory right now. There will be market corrections, there will be different things happening in the market, there will be great apprehensions. But if you keep it simple and if you master your game, and the mastery of your game is 5 points. Putting short-term money in deposits or debt fund. Putting long-term money only into equity. Investing steadily over a period of time, making sure that your money is diversified. If the money gets concentrated because you invested in a diversified fund, but that money got concentrated into large caps only, take it out, diversify again. And diversify well, keep it handful, make sure that if you are investing through a mutual fund, some position is at least 10% so that you don't have more than 10 funds or 15%. And that is very important because you should be interested. The result of, when investors go about making their life interesting with investments, they end up being a collector. Then they end up not tracking their investment. They are less interested. Then you have some nominal investment, 5 lakh rupees, 2 lakh rupees, 1 lakh rupees, 50,000. It's very little money. Sometimes the investment does very well. You feel happy, but there is not enough money there. So, investing should be carefully done, few funds, invested well, and just keep track of it. That's about it. Keep it simple, and that is smart investing. And of course, keep listening to us.
All right. Now, in 2025, how should investors balance risk and rewards while choosing between equity, debt, and hybrid funds?
I would like to give, one or two tips to particularly the audience, which is our very ardent follower. Which is, retirees and the people who are going to retire. I keep saying that invest in long-term equity fund, diversified vehicle. Now think of one thing. Mutual fund is a great vehicle where once you invest your money, till you take it out, you don't have to pay taxes. Assuming that in your retirement you think that you don't want that extreme volatility. You want little lower volatility. You should be investing 25% of your money in fixed income. 75% will be in equity, and you don't need much money, but you would not like that wild movements. If you have to do it, you have two choices. One is invest 75% money into an equity fund, remaining 25% into a debt fund or make a deposit or something like that. When you put that money in a deposit or buy a debt fund, 25% of your money, you will be periodically rebalancing it. That will lead to taxation. If you choose an aggressive hybrid fund, you have achieved this. Not only you have achieved it, you have made it more tax efficient. One is that till you take any money out, you will not be liable for any taxes. Possible that your money keeps growing and steadily growing, and the money will be less volatile as compared to an all equity fund. Third thing is that if at all you take your money out, after 1 year, any amount of money for a periodic holiday or something in between, whatever be the gain, it will be taxed at 12.5%. So you are, one is that you are getting a beneficial tax treatment. Your money is growing in a very passive way. Your money is growing very well in a compact manner. Your 25% equity 25% fixed income gets treated as equity. I think this is a very smart move. Likewise, I think, doing your SIP in a diversified fund, diversified equity fund, and by diversified, nowadays I have changed my definition from flexi cap to multi cap because they seem to be, doing the job of a full exposure to the market much better. But assuming that doing your SIP, retirees putting their money into aggressive hybrid fund, I think these are very small tricks which which looks like trick, but it is nothing. And this gets you so much of peace of mind, good night's sleep, and confidence in the market, because you are able to reduce your volatility, optimize your return, and make things very favorable.
Right. Now in 2024, thematic funds, sectoral funds, they were very popular among investors. What would be your advice to investors for 2025?
Stories sell. And mutual fund is also a consumer product. So people are weaving stories that this magic will happen, that magic will happen. And the problem of the story is that the story becomes very compelling when the story has already happened. After it has happened, then it looks very attractive. Yes, this much has gone up. And an investor's favorite pastime is to chase recent performance.
Right.
And these sector and thematic funds build a very nice case. This has done very well, ride the bus now. And you don't know whether the ride is coming to an end, whether you are at the pinnacle of that, and we have seen it, it's very difficult for to persuade investors who has made up his mind or is a relatively new investor. It happened in mid-90s, it happened in 2000, when the technology boom happened. In 2007, there were infrastructure fund and infrastructure fund. So the sectoral fund and the thematic fund, the general tragedy is that it comes at an inopportune time. It catches the attention of the most vulnerable guy who is not experienced. The story looks very compelling, and it is too good to be true to last forever. And accidentally, sometimes it happens soon after you have invested. And then it becomes a disappointing thing for a lifetime. So to have a good experience, I think anybody who has crossed his 30s or 50s, 40s, and still getting started with mutual fund should always start with an aggressive hybrid fund. Because you are just not used to the madness of the market. And somebody who is young, he can well start with a small cap, he can well start with a multi-cap fund, that's fine. But never start with anything which is narrow. Because one of the key benefits of investing in a mutual fund is to gain quick diversification with convenience, and that is a compromise.
Now, coming to selecting funds, how important is a fund manager's role or a fund manager's track record to zero down on a fund? And what are the other metrics that one should look for?
That is all there to it. Because everything else being equal, fund manager makes a big difference. That he is the biggest differentiator. And not because how much he has earned in the past, because what a fund manager has done is one part of it, because that will be a function of the state of the market. If the market has crashed and if the fund manager has 1.5 year experience and the whole period, so I don't think any fund manager will help you escape that. But what is the thinking? But I would look at a fund manager who has at least been through a 1 or 2 market cycle, a phase of falling market, a phase of rising market. And if the fund manager has successfully fallen little less and has been able to rise little more, not too much, I'll be fine with it. And then I would like to see that how bad it gets when it gets bad. Because there are fund managers, when the tide turns, their portfolios become illiquid, their inexperience becomes visible. There are fund managers in their ability, I have so much confidence that even if they are not doing very well for maybe 6 months, 1 year, 2 years, they're still worth sticking around. Maybe it is an opportunity for somebody to accumulate through the lean times. So don't put mutual fund under a microscope. And if you are looking at mutual fund from that perspective, invest in an index fund. I would say that everybody should start and should not make excuses for not investing. Start with an index fund, start with an aggressive hybrid fund. Even start with a thematic fund if it actually pleases you. Because first 6 months, 1 year, but do your SIP. If you do your SIP, you will end up having a positive experience, and that is very crucial for any investor to start.
Are there any other metrics that one should evaluate before making a decision?
I would say that the first thing which, from an investor's point of view, choosing the right vehicle is the first battle. leave aside which fund company, which fund manager, decide which kind of fund you will have. Because if you are going to save taxes, then it's very straightforward. Diversified equity fund, which are tax saving fund. And if you are done with your 1.5 lakh rupees, don't invest anymore. So just choosing 1 or 2 tax saving fund is good enough. If you are investing for the long run, doing your SIP, choose a multi-cap fund. If you are used, you can withstand the ups and downs. Doing your SIP. If you are over 40, getting started now, as I said, start with aggressive hybrid fund. After you have done this, which funds to choose? One is that, I do it in a 3-step process. One is that I go to value research and do a universe of 3-star, 4-star and 5-star fund of a category which I have decided. And in our stock fund selector, I can also choose multiple categories. So I choose, I choose a diversified categories, which is large and mid cap fund, the value funds, the multi-cap fund and the flexi-cap fund. Once I have done these 4 categories, which I think is a very diversified exposure, once I have done that, then I see that a fund with a 5-year history and a fund which means a fund with a 5-year history has also a 3-year performance history. Then I see that the fund manager is still around, and it is all available in a listing on our fund selector page, that what is the tenure of the fund manager. And if he has been around for 5 years and this fund has been able to deliver little more than the benchmark, and it is in the top quartile or top half of the funds in that universe, I'm fine. I'm taken care of. I have reasonable track record history of somebody who has been able to withstand some big declining phase and has been able to reasonably participate in a rising phase as well. And my 3-star, 4-star and 5-star universe make sure that it has a above average risk adjusted performance relative to its peers.
Okay. Now finally, for investors who are new to mutual funds, what is the best strategy to build a resilient portfolio for the long term in 2025?
New to mutual fund, start somehow. Do any SIP, and do conservatively, do aggressively, do whatever. But start right away and don't worry about the market. You will be getting 50 excuses why you should not invest. And I can tell you from my experience of looking at and giving television interview, radio interview or writing columns for last 20 years, that the start of the year starts with, or start of year or or some special occasion or some Diwali, everybody will give predictions about what is in store, what is going to happen. It's all useless. Make a plan, stick to it, and that is what works.
All right, now moving on to the viewer's question. One of our premium subscribers has sent this. He says, do you recommend investing in ULIPs? Previously, it was not recommended to mix insurance and investment. With new age ULIPs, the fund charges have reduced. One of the main advantages in ULIPs over equity mutual funds is no long-term capital gains or short-term capital gain charges when moving investment from one scheme to another, like moving from one equity index to, say, debt fund. So what's your advice there?
The reason why I suggest that one should not mix insurance and investment is not because it has become tax efficient, or you can in a ULIP you can rebalance or change your allocation. I do it because insurance is a very important objective. Insurance coverage in my priority. If I have financial dependence, and if I have no net worth, I'm starting my career, I got married, I have a small child, I need insurance. Nothing else can actually compensate for the need for having a large coverage. That is the only way to secure myself and my family financially. So when you buy ULIP, you don't get adequate insurance coverage. That's one. Second is that if your fund is not doing well, you can replace it with another fund. If your ULIP is not doing well, you can't take your money out, because after that you'll lose all the benefits and all the coverage, and possibly it will also become taxable. Because you can't actually market linked investment, you need to keep an eye on them. You can't invest and sleep over it for many years. Third is that insurance and investment, mixing it up, you can achieve this goal of investing in equity or debt by opening an NPS account. You can put your money in NPS tier 2, move money from equity to debt, from debt to equity, and there is no tax incidence. You can do it as many times as I think 4 times in a year. If you can do that, that need is fulfilled, but it is not bundled with insurance. So get your life insurance as a term cover, make your investment in mutual fund, or if you want to have this rebalancing and it is far lower than a ULIP and even mutual fund. NPS Tier 2 is possibly world's least expensive, cheapest fund management available to any person.
All right, with that, we've come to the end of this episode, but keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.